90% of investors lose money in the markets, and even worse, most people don't even know the traps they've fallen into. But that ends today, because in this video, I'm going to rank the 7 worst investing mistakes that investors make. That way you can see why most investors fail. And then I'll show you how top investors do things differently. That way you can build a game plan to build real wealth. Mistake number 1 is you don't invest your money. Most people in America statistically are following one of the 2 S's. You're spending all of your money or you're saving all of your money. Let's start with the first S, spending all of your money. Somewhere between 55 to 75% of Americans, depending on which study you read, are living paycheck to paycheck and are flat broke, meaning you make money, then you spend all of your money on your rent and your groceries and your car, and then you have no money left over to go on a vacation, to save any money, or to invest. Well, at the same time, we got a new study in 2025 which says that a little bit over 70% of Americans own a Netflix subscription. Now, I am not the best math nerd out there, but if you do some basic math, what this tells me is that most Americans are spending more money on their Netflix subscription than they are on their investments. And I want to see that flipped. I would rather you invest more money than you spend on Netflix, but of course I'm not the king of the world, but that's the first problem, is that we prioritize the wrong things. We want to have this comfort and freedom and this release. I get it. Look, work is hard. Trust me, I get that. But if you don't have any investments, if you don't have any savings, if you're drowning in credit card debt, how can you comfortably sit there at night knowing that your family is relying on you and you have no money in case anything were to go wrong, let alone having any freedom for your family? I want you to reframe the way that you think. Secondly, it's you save all of your money. Now, I grew up in a traditional Indian household, and in the traditional Indian household, it is a save-heavy culture. I made a joke that Americans make $1 to spend $2, Indians make $1 to spend 20 cents. And what you do now is you work to make a big salary because you become a doctor or an attorney or an engineer, and then you don't spend anything. Well, the problem with that is your savings are slowly losing value to inflation. If the average savings account is 0.5% and inflation is 3%, that means your savings are losing about 2.5% of their spending power every single year. So if you have $100 in the savings account, you just lost $2.50 of buying power by saving the $100. If you have $1 million in your savings account, you just lost $25,000 of buying power through this risk-free investment, which is keeping your money in the bank. Now, there's a time and place to save, but saving all of your money is not how you become wealthy. The way that you become wealthy is by investing your money. Mistake number 2 is the casino effect. Warren Buffett says that more and more investors are treating the stock market like a casino. Robinhood has added gamification into their app, so you celebrate buying, you celebrate trading, which can turn your investing into more flipping. Not to mention the fact that slow compounded growth of your money doesn't sound very attractive, because the average market return has been 10% a year, which if you ask anybody on the internet sounds so boring and dry, because Bitcoin has been averaging 100% a year. In fact, maybe a little bit more than that. So why would you want to try to get this 10% return when you could get 100% return a year? Well, let's just do some math. The best investor in the history of time is Warren Buffett, and he is now one of the wealthiest people in the world. He's a multi-billionaire. Well, his average return, because the way he built his wealth is by investing his money, his average return has been around 19% a year. Now, yeah, that's a lot more than the market average, but it's not 100% returns a year, but he's been able to become one of the wealthiest people in the world by compounding 19% returns a year. So this is where it can be very attractive to fall into, how do we get these types of returns? But statistically, these types of returns are high risk, high potential reward. And chances are you're going to lose money, especially over the long term. Or maybe you're not going to see the returns that you want. Now, I'm not saying crypto is a bad thing. I'm not saying you shouldn't buy Bitcoin. What I'm saying is you got to understand the risk and reward nature and the volatility that comes with more speculative assets. Because the way that I invest my money, and I can't recommend what I do to anybody else, is I want to be diversified against bad things happening, because we know the market crashes happen. We've seen 16 recessions over the last 100 years. We've seen 25 market crashes over the last 100 years, and chances are we're going to continue seeing more in the future. And when those crashes happen, the speculative assets fall even further, than the non-speculative assets. And this is where I invest my money into my own business, Briefs Media. I invest my money into real estate. I invest my money into stocks. I invest my money into speculative assets, which include things like cryptocurrency, includes things like startups. And then I own some physical gold. Gold makes up about 2% of my portfolio. But the speculative assets, the speculative part of my portfolio, make up about 18% of my total portfolio. And the only reason why it's 18% is because I have built more wealth through my stocks and real estate. I know I've been very fortunate to be able to do that, but that's why I've now expanded my speculative part of my portfolio because, well, it's more risky, but I also know that if my speculative investments went all the way down to zero, I would be completely fine. And so when you're starting out, understand that speculative investments can make you a lot of money, but they can lose you that money just as fast. And so if you want to invest in them, fine. But just make sure that they fit in your portfolio as a speculative piece of your portfolio. Now, listen, I'm not a financial advisor. I'm just a random guy on YouTube. I can't tell you what to do with your money. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But history doesn't exactly repeat itself, but it does rhyme. And this is where it is very valuable to take a look at history and understand what the possibilities are. That way you can position yourself in a way to actually win and build wealth, as opposed to just trying to gamble your way, maybe flipping your way, trading your way, and trying to find the next hot meme stock, the next hot meme coin as a way to build all of your wealth. Some people will do it, most people will not. Mistake number 3 is missing the big market moves. Now, I also want to remind you that if you are an investor or want to become an investor, my team and I have put together a brand new free investing masterclass where I'll walk you through how my team and I look for investment opportunities before they hit the mainstream, before they hit the crowd. I'll show you the same system that my firm uses to find and research investment opportunities. It's a completely free masterclass. And when you register for the masterclass, you also get Market Briefs, my investing newsletter for investors, as a complimentary bonus. So if you want to get my investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to register and get it all. Warren Buffett has a saying that time in the market beats time in the market. And what that means is nobody can predict when the next market crash is going to happen. We know the market crashes will happen, but we don't know if it's going to happen tomorrow or next week, next year, or next decade. We also don't know when the bottom is going to be. We also don't know when the top is going to be. And a lot of people want to perfectly time the markets. But instead of trying to time the market, just keep letting your money compound in the market. Just keep buying the markets every week or every 2 weeks or every month. Because if you do that, if you just let your money sit in the market instead of trying to time the market, chances are you're going to win. And let me just show you some data from Bank of America to back this up. Bank of America looked at the impact of missing the market's best and worst days of each decade between 1930 to 2020. And what we can see is that over these 9 decades, markets grew by 17,000%. Now, if you were a great investor and you did not have your money in the markets on the 10 worst days per decade, you would see a return of 3.7 million%, which means, yeah, you got really rich. But what if you were a little bit wrong? If you exclude the 10 best days per decade over these 90 years, you would have only gotten a 28% return on your money. So if you just kept your money in the market instead of trying to time the market, well, then you would have seen the 17,000% return. Mistake number 4 is investing on emotion. Markets go up and markets go down. We have seen this trend happen for decades and it's going to continue to happen. And the same thing happens in each one of these downturns. People panic, they sell, and some people become incredibly wealthy. For example, in 2022, we saw the stock market, more specifically the S&P 500, fall by around 20%. In 2020, we saw the S&P 500 fall by around 34%. In 2008, during the financial crisis when the real estate market crashed, we saw the stock market fall by around 57%. And then during the 2000 dot-com bubble bursting, we saw the stock market, again the S&P 500, fall by around 50%. By the way, the S&P 500 is just a basket of stocks that looks at the 500 largest companies in the stock market. So what have we seen through history, at least in the last couple decades or so? We have seen markets go up and we've seen markets go down. Over the long term, we have seen markets go up. Markets are a lot higher today despite all these recessions, despite all these market crashes. And in each one of these downturns, what we saw is that people panicked and they sold. I like to call it poop. P-O-O-P. Panic, leads to overselling, leads to opportunity, leads to profits for those that are long-term investors. And in each one of these downturns, we saw poop happen. Poop happened in 2022. People panicked and sold. Some people got very rich. In 2020, poop happened. Some people panicked and sold. Some people found the opportunity and profited. In 2008, poop happened. People panicked and oversold, which created opportunity for profit. In 2000, poop happened. People panicked and oversold, which created opportunity and profit. Why am I saying this? Because if you are a long-term investor, you don't want to get caught up with the emotion. You want to understand that, hey, these things happen and they're going to continue to happen. And if you're going to make any changes, well, assuming you hold on to good investments, not things that are on the verge of bankruptcy, this can create opportunity for you to come in and buy at a discounted price, because recessions and market crashes create more millionaires than any other time because they allow savvy investors to come in and buy good investments at a discounted price. Number 5 is short-term thinking. Now, because of option trading and Forex and penny trading and day trading, it's become very easy to get caught up in this idea of wanting to flip my stocks very quickly. But the reality is, as an investor, the goal is not to flip. The goal is to own for the long term, years, if not decades, if not essentially forever. And if you own these good investments for a long enough period of time, assuming it's a good investment, chances are you're going to make more money. Because that's what we've seen through history. Because if you own a good investment that's working to compound their income, compound their profits, well, you have the ability to see the value of your investment grow. Now, it can be very hard to do that when everybody else around you is always talking about flipping, but the real value is in holding for the long term, not to mention the fact that when you own your investment for longer than a year, you also get tax benefits. Because when you own your investment for longer than a year, you now qualify for long-term capital gains rates. And all that means is you qualify for lower tax rates because the government is incentivizing you through lower taxes to hold your investments for the long term, because history shows us that when you own your investments for a longer period of time, you have a better chance of making your money. It's not guaranteed, but your risk goes down if you have a bigger time horizon. Mistake number 6 is you ignore fees. If you invest your money with a 401k, if you have a financial advisor, if you invest your money into an ETF or an index fund or a mutual fund, you are paying a fee, and most people have no idea of how these fees work. So let's take a look at an example. Let's assume hypothetically that you can invest $1,000 a month. You invest this money for 30 years. You can get an 11% return on your money, and you're investing your money with a financial advisor who takes a small little 1.5% fee. Well, over the course of your career, if you get this 11% return, that means your advisor is going to take about $600,000 in fees, because while your money is working to compound and grow, so are your fees, and you're going to be left with $1.8 million. Again, that's a lot of money, but you have to understand the cost that you have with these fees. This is fine for some people because now it's completely hands-off, and now you don't have to worry about it. You have a professional managing your money, assuming that they're good. Make sure you do your research. But the whole idea here is you got to understand the cost of that fee. And a lot of people don't even realize that a 1% fee or a 1.5% fee, which a lot of advisors do charge somewhere between 1 to 2%, that can cost you hundreds of thousands, if not millions of dollars, depending on how much money you're investing and how much time your money is going to be invested for. And yes, you could do it yourself. It's not for everybody. For some people, a financial advisor is 100% worth the fee, but you got to know the cost. Now, if you invest your money into a low-cost index fund or a low-cost ETF, your fees are going to be a whole lot less, and you want to understand that those fees still exist. This is called an expense ratio. That's what you want to look at. If you have a 401k, if you're investing in an ETF, in an index fund or a mutual fund, you want to look at that term expense ratio, because that is going to be your fee. So let's do these numbers with a smaller fee. Now, same scenario. Let's assume you invest in the same $1,000 a month. You do this for 30 years, you get the same 11% return. I'm going to assume that you get the same return here just for simplicity. But now you have a low-cost fund that you're paying 0.1% on. Now, you do have to do a little bit more work than here, because you have to find the fund, you have to keep investing in it, you have to make sure you don't sell it and all of that stuff. But in this situation, now you're going to be paying around $40,000 in fees over the course of your investing career, a whole lot less than this, and you're going to be left with around $2.34 million. Again, this is going to be right for some people. This is going to be right for some people. For other people, they're not going to want to do either of these. They're going to want to invest their money themselves into their own active investments. But you have to understand how fees work, because a lot of people are just blindly investing their money without a clue of how much these fees are going to cost. And if you can make a small little change on the fee, that could add up to huge dollars, at the end of your investing career just by understanding what these fees are and maybe negotiating some of these fees a little bit lower. And this brings me to mistake number 7, not knowing your strategy. There are 3 ways that you can invest your money, and I'm not talking about trading or flipping, we're talking about actually investing your money, and a lot of people don't actually know which strategy that they're following, and then they flip between one or the other. Number 1 is you can be completely hands-off. This is by giving your money to a financial advisor like we just talked about. Number 2 is about being a passive investor. This is by investing your money into funds, ETFs, mutual funds, index funds. And now it's not completely hands-off because you got to manage these funds, but you're not actually actively making decisions on what stocks those funds should be investing in. You just keep investing, holding on to those funds. And then investment style number 3 is by being an active investor. This is being a little bit more involved. The most risk for the most potential return. This is where you're actually doing the research on which stocks to invest in. You're studying where's money moving. This is what my firm does a lot of research on, is active investing. This is what we focus on. It's more risk for more potential return, but if you can beat the market slightly, that can compound to a lot more money, a lot more wealth on the back end. Again, it's not for everybody because now you have to actually keep up with companies and listen to earnings calls and read the financial statements and study what the company is doing. More risk for more potential return. But if you're able to do it, it can add up to a lot more returns on the back end. And again, I'm not talking about 50% returns or even 20% returns a year. Just 13% returns a year can add up to $1 million plus over the course of your investing career just by getting slightly better returns on your money. So the mistake that a lot of people make is they say, I am going to be a passive investor. I'm going to invest my money into the S&P 500. Now I'm telling you this example because I've seen this happen too many times. And then as soon as the markets go down, you panic, you freak out, and you sell. I know this because I have been creating content on YouTube for about a decade now.
Who is this guy and what is the minority mindset?
Happy birthday to you.
It's crazy to believe that I've been here for 10 years. But over the last 10 years, I have seen the 2020 pandemic crash, and I have seen the 2022 stock market downturn. I've seen the 2025 market turbulence in the first half of the year. And in each one of these scenarios, what I've seen happen is that people panic and then they start to sell. Even those that are passive investors, they say, I'm going to be a long-term investor. I want to invest in the S&P 500 for the long term. And then as soon as you see the market's downturn, people freak out because you feel like everything is going to collapse. And now you sell at a huge discount, and then the financially savvy come in and buy at a huge discounted price. And this is where I want you to know the strategy. If you want to be a passive investor, you have to be investing for the long term. As an active investor, you got to be willing to put in the work and invest for the long term, which brings me to the final part of this video, which is how do you actually win and not make these mistakes? And this ties in nicely with this, which is you have to know how do you actually win in each one of these strategies. If you're going to be a hands-off investor, then let your financial advisor do what they have to do and get yourself a good advisor. Understand their fees, understand their goals, and make sure that their goals are aligned with yours. And then you have to hope that you have a good advisor that's going to manage your money well, and you can study their track record and all of that too. But when it comes to being a passive investor, the way that you win is by following what I call ABB. Always be buying. So you find the funds that you want to invest in, and now you set it and forget it. That means every week, every 2 weeks, or every month, you're going to be buying. You buy when markets are up. You buy when markets are down. You buy when markets are sideways. You buy when it's a Republican in the White House. You buy when it's a Democrat in the White House. You buy when it's raining. You buy when it's snowing. And you buy when it's sunny outside. Always be buying means always be buying. And now when you have that strategy, assuming you have a good asset, this has been proven to win. But you got to be willing to go through the ups and downs and hold on to this for the long term, and it's been a winning strategy. As an active investor, the way that I like to look at this is by studying market shifts. Now, when you study these market shifts, what that means is you want to study where the money is moving. Where are opportunities shifting? Are people spending more money on this industry or that industry? For example, when the pandemic happened, everybody went out and bought a cat or a dog. Feels like that, right? Well, that's a type of shift. Why is that a shift? Because as people buy more cats or dogs, people need more cat and dog food. People need more vet care. That creates an investment opportunity because that means more money is going to be flowing into those shifts. When President Trump came into office, well, he started imposing tariffs. That is a shift because those tariffs mean the money is going to flow into different people's hands, and that also creates investment opportunities. This is the way that you need to be thinking now as an active investor. And this is where, again, when you join my investing masterclass, you'll see how we find these market shifts because it's more focused on that active investor. But the whole idea is understanding where the money is moving. That way you can invest your money not based off of what's on CNBC or Reddit or the news headlines. You're investing based off of data. You're investing based off of research to find those opportunities before they hit the headlines. And that's why it's so important for you to understand what your strategy is and then being willing to stick to your strategy and know how you can actually win. So we went over the 7 big investing mistakes that cause so many people to lose money in the markets. We know that markets go up over the long run, but in order for you to actually make money over the long run, you have to be willing to invest for the long term and know what your investing strategy is and make sure that your research strategy, investing strategy aligns with the way that you're going to invest your money. So if you enjoyed this video, the best thank you is to share this video with a friend, a colleague, a family member, or a fellow investor. And again, if you want to watch the Investing Masterclass and get market briefs, I have that link for you down in the description. In the early 1970s, the United States government had borrowed so much money. President Richard Nixon severed the tie between the United States dollar and physical gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
Now, if you notice what he said this was temporary, and here we are 54 years later, and the dollar is still not